Hello, I'm Arsenault, Chief Investment Officer here at TrustPoint. I would like to take a few minutes today to provide some insight on current market conditions, how to think about what's happening, and what we're doing to help protect your portfolio. Year to date, the global equity market is down 22% and the global bond market is down 10%, making the start of this year one of the worst starts in the last 100 years. There are three things I would like you to do during this period of heightened uncertainty and volatility. Number one, stay disciplined and resist the urge to do something. It's a basic piece of advice, but an important one. Exiting the market because of a decline and sitting on the sidelines until things calm down may feel like the right thing to do now, but it often creates problems. Let me explain. Trying to time the market means you need to not only decide when to get out, but when to get back in. Making two perfectly timed decisions back to back is difficult, very difficult. And when these decisions are emotionally driven, as they often are, they can prove costly in the long run. To prove that point, let's look at what the famous dalbar study shows. Over the last 20 years, the average investor on their own has achieved a relatively mediocre 3.6% annualized return compared to 7.4% for a balanced portfolio of 60% stocks and 40% bonds. Unfortunately, badly timed investment decisions, often emotionally driven, are mostly responsible for the difference in returns. Sell high, buy low. This is what investors should be doing, but the reality is that most investors do the exact opposite. They sell low and buy back high. They sell when most of the decline is already behind them, and then sit on the sidelines for too long before getting back in. Historically, over a third of the market's best days took place in the first 2 months of a bull market, before it was even clear a bull market had begun. That just shows how difficult it is. Even if you get the exit decision right, it's very difficult to get back in before it's too late. Okay, resist the urge to do something. Don't change your plan in the middle of the storm. That was number one. Number two, embrace volatility. Yes, embrace volatility, celebrate it. Why? Because it creates opportunities. It's easy to panic when faced with volatile and declining markets, and many do. But know that market declines are just part of the investment journey. Expect them to happen, so when they do come, you're not surprised. Over the last decade or so, the S&P 500 experienced over 24 declines of 20% or more, often referred to as bear markets. Every single one of these declines restored value in asset prices, and greater value in asset prices provides opportunities for higher future expected returns. Now, practically, what does that mean? For assets that are already invested, stay the course. If you have extra cash on the sidelines, think about setting up a plan to put that cash to work. And we can help with that. Now, adding 3 to 6 months of liquidity in cash is always recommended. Bump this up to a year's worth of expenses in retirement, even 2 years if it allows you to sleep better at night. Once you've established this, set a plan to put any extra cash you have to work for you. Take advantage of the opportunities that are created by panicky sellers. As the previous chart showed, cash is the worst performing asset class over the long term. So cash is not always king. In fact, cash is rarely king. Let's come up with a plan to put that cash to work. Number one, resist the urge to do something. Number 2, embrace volatility. Be greedy when others are fearful. Number 3, enjoy the summer. Enjoy the summer. Enjoy what you like to do best. And don't spend too much time listening to CNBC, Bloomberg TV, or reading financial papers about what to do now. Because over the long term, markets reward patience more than anything else. We often say to our clients, it's time in the markets that works, not market timing. Regardless of the reasons behind a bear market, they don't last. They never do. And this time will be no different. With these things being said, we understand it can be challenging for investors. That is what we are here for. And we invite you to give us a call to talk through your concerns at any time. So I ask you to do 3 things. Let me now tell you 3 things we are doing or have done already to make sure your portfolio is tactically positioned to weather the storm. Number 1, in both February and March this year, we made changes to portfolios in anticipation of a more difficult and volatile macro and market environment. As part of these changes, we reduced equity exposure across the board in all of our clients' portfolios. Number 2, within the equity portion of portfolios, we are avoiding companies with little or no earnings and weak balance sheets. Many of those are down 50% or more year to date. And we are favoring companies with strong earnings and strong balance sheets. Number 3, within the fixed income portion of portfolios, we are maintaining inflation hedges and have been very cautious on interest rate risk or rising interest rates by keeping duration lower than most bond market benchmarks. As always, we continue to monitor the macro environment and markets carefully and stand ready to make additional changes if needed. If you are interested in a more thorough analysis of our views, I invite you to listen to our 30 minutes webinar recorded on May 16. The recording is posted on our website under News and Insights. Also, watch our emails for upcoming webinars in the future. Lastly, I want to thank you for your trust in us, and I want to congratulate our clients for already embracing the advice provided today. Thank you. Enjoy the summer and enjoy what you like to do best.